My name is Oluwa Tosin of Money Africa, and today I'll be speaking to you about something interesting. Guess what? It's one of the favorite asked questions. How do I invest 100,000 Naira? Now, if you're watching this for the first time, Money Africa is a financial literacy platform where we teach you all you need to know about your money. So we're talking about how to make money, how to grow it, and how to build it in the long run. So guys, you can click here to subscribe to our channel and also give us a thumbs up. So you know what's so interesting? Every time people ask us, Money Africa, how do I invest 100,000 Naira? What they are technically saying is, how do I manage my risk? That's it. So every time people are asking you, how do I invest an amount of money, they're basically asking you, how do I manage my risk? At the end of the day, the primary job of every investor is how to manage that investment. And when people do not understand it, that is where they make mistakes. So now you're probably thinking, I'm going to give you one size fits all answer. No, I wouldn't. I'll give you scenarios and then you can apply to how best it works for you. So the very first thing we're looking at is the different risk buckets, and we have three primary buckets. Number one, the very first bucket is your low risk. The job of a low risk bucket is to what? Is to preserve. It preserves your capital. So you might not be making anything out of this world in terms of return, or even if we put it like this, what is inflation rate? Inflation rate is basically what is the increase in the prices of goods and services in average in that particular market. So for instance, let's say you're in Nigeria or you're in the UK, what is your inflation rate? In Nigeria, the inflation rate is approximately 17% as of today. Now, this is July, this is August 2021. Right? But in other years, it's always an average of about 12%. So please stay with me. Let's go back there. So when you're thinking about a low risk asset, the return is usually lower than inflation rates, right? So it might not adequately help you take back what inflation has stolen from you, but what it does is that it gives you the comfort of safety. You can sleep at night. It's where you can put money in and sleep at night. It's where you can put money in and have peace of mind. It's where you can put money in and not worry that, oh my gosh, what's happening in the market? Is my money gone? No, it's safety. And we always advocate for safety. Safety is very important. Now, it gets very interesting. If you're under the age of 30, you have little responsibilities amongst others, you're relatively young. You are young actually, not even just relatively, you are young and you have enough time to catch up. So we usually see a lot of young people wanting to take a lot of risk and we advocate for that. But even then, we always say balance your risk. So under this bucket of safety, if you were to see someone that is going towards retirement, someone that's already at the age of 60, they will most likely gravitate towards this bucket, right? Because they're already now old and frail, or they're closer to retirement, they don't have enough time to actively work and make back that money. So preservation is extremely important to them. But guess what? Even as a young person, everyone should actually consider sitting down in safety with a certain portion of their investment, not everything. Fantastic. So we have the safety bucket. So what falls under safety? Under my safety bucket, I have things like treasury bills, currently not doing well in the market as of August 2021. You could be watching this video 5 years from now. Also, another thing in that bucket is government bonds. Another thing in that bucket is money market mutual funds. So you see a lot of asset management companies in Nigeria offering mutual funds. Money market mutual funds is one of the ones that are safe. Right? What else falls here? We have a lot of fintechs that are saying, oh, invest with us, get 10% per annum, amongst others. So Money Africa has a sister company called Get Ladder. On Ladder, you get savings for about 10%, and it also falls under that category. So while the returns do not fully cover your inflation rate, it provides what? It provides safety. So that is category one. Category two, under category two, it's medium risk. The job of your category two is that you could make some money and you could lose some money. But guess what? When you do it intelligently, you can actually balance that risk out. So we want growth. The job of category two is for growth. What falls under this category? We have things like stocks and we also have things like ETFs amongst others. So what is stock? Stock is also known as shares. Stock is also known as equity. It's owning a piece of a company, right? Owning a piece of that company. Now, the beautiful thing is, about 3 years ago, Nigerians living in Nigeria did not have exposure. I'm talking about retail investors, people that did not have the financial muscle to invest like $100,000 at once. They did not have exposure to the global market. But as of today, things have changed. I can sit down in Lagos and buy shares in Apple. I can sit down in Lagos and buy shares in Amazon with as little as 5,000 Naira. So now you can start investing in those kind of things. So under this medium risk asset, we have the stocks and we also have ETF. Now it gets interesting. In the global market, there are a whole lot of stocks there, right? I'm talking about hundreds of stocks. Now people are asking, oh my gosh, which stock should I choose? How should I go about that? Do not worry, now other video will dedicate it to how to choose good stocks. So you're looking at things like management, you're looking at things like dividends, you're looking at things like growth, amongst others. But these are your options. So you have Apple, you have Amazon, you have all these different things that you can actually choose from. But guess what? Despite the fact that many people have options, what usually happens is they could also be choosing stocks that are not performing well. But there's something else. There's something else. There's something called an ETF. What is an ETF? An ETF is like a cocktail. In actual fact, it's called an exchange traded fund. An exchange traded fund basically means that it mashes up different other stocks to create a new stock, a new currency. Now, let me bring it to layman terms. I love to liken it to a cocktail. Think about a cocktail. I'm talking about a fruit cocktail. You have pineapple, you have banana, you have watermelon, you have lemon, you have all these nice different things to make up this nice fruit cocktail. All those different elements going into that cocktail is actually the stocks in this case. So I could have Apple, Amazon, Walmart, and all those different things inside, Netflix, Zoom, all these different things inside, making this new drink. So you can see that this cocktail is like the new drink, right? And the beautiful thing about this is that it diversifies your risk. So what does that mean? All the stocks cannot be going in the same direction at the same time. So for instance, let's say Apple and Amazon is going up, and let's say Walmart is going down and Zoom is going down. What happens is that you can use the gains from those ones going up to offset the losses from the ones going down. And that's the beautiful thing about diversification. You get to benefit from all these different stocks without having to buy all of them individually. And that's the main benefit of index fund. So we always advocate for beginners to actually start with index fund. Now it gets really interesting. There are many people that pick individual stocks and their portfolio is not working well, but if they were to sit in that index, it would give them a decent return. Now it also has a disadvantage. Let's say you were to buy into an individual stock that really outperformed and performed really well. Because you do not have it on its own, you will not get all that benefit at once. However, numbers do not lie, and based on numbers and what has happened in the past, a good index fund delivers approximately about 10% per annum. If you compound that, that is really good. So what falls on that here? Individual stocks, I'm talking Amazon, Apple, and a couple of others, and we have different indexes tracking like the 500 largest companies in the world, the S&P 500 Bull, and a couple of others. So there are lots and lots of indexes there. Now, this is what falls under medium risk. Now, the last but not the least is the high risk asset. So what falls here? High risk asset, as you can hear, is very volatile. In this kind of category, this is not where you put money that you need immediately. This is not where you put your emergency funds. This is not where you put money for school fees. Anything that requires you needing it in the short run, this is not where you put that kind of money. Why? Because you cannot predict the market. Imagine going to bed and waking up the next morning and, oh my gosh, you know, government is going to ban crypto, or one of the influencers or the biggest person in that space that said something negative about it, and then you start seeing that market plummeting. What happens to your school fees? What happens to your rent money? What happens to your emergency funds? So we strongly advocate that it's not where you put an emergency fund or a bulk of your safety money, right? It's a risk. Because of the high risk profile, you also have to be very careful with your exposure there. So it could be what, 10% of your portfolio or even less, depending on your risk appetite. So now the other thing about a high risk asset is higher the risk, higher the return, right? And even though that statement is not always true all the time, but cryptocurrency tend to, sometimes the coins really perform well, right? Again, that's a different ball game on its own altogether. You might want to read up more about Bitcoin, Ethereum, and the rest of them, how they work, how to position in the long run, amongst others. We'll also be delivering a longer session on that. So to summarize my session for today, how do I invest 100,000 Naira? How do I invest 100,000 Naira? Fantastic. It depends from people to people. I could say, how about this? A 50-20-20-10 ratio. What happens here? You put 50% of your money in safety, something you can sleep at night, something that is safe, something that basically just preserves your capital and protects. You put 20% in individual stocks, right? So what are the biggest stocks in the market that have performed well over the years? You put another 20% in ETFs, right? Remember we spoke about index fund that gives you diversification, and you get to have best of both worlds by being in that fund. And then you could also put 10% into cryptocurrency. So I'm talking Bitcoin, Ethereum, and a couple of others. Again, this is not financial advice. It's a suggestion of how you could split your 100,000 Naira. At the end of the day, the decision sits with you. You are the investor, you understand your risk best, and you want to know how best can I go about it. So guys, I want to hear from you. What do you think? Would you do a 50-20-20-10? Would you rather increase your exposure in safety and only put like 30% of your portfolio into medium and high risk? How would you apportion your investment into the different risk? I want to hear from you. So guys, go into the comment section, talk to me. I want to know, how would you invest your own 100,000 Naira? Have given me a suggestion, and I'd actually love to hear what you think about it. Thank you. Do not forget to subscribe and share this with your loved one. My name is Oluwatosin Olasende. I'm the founder of Money Africa, and we are here to always give you all you need to know about your money. Thank you.